Good morning and welcome to another episode of Moms in Real Estate in the Morning. Today's one of our favorite Mondays because it is Masterclass Monday. And we have a lot of people here with us today. So Kristen, why don't you take it away? I'm so excited because we're introducing some new community partners.
Yeah, so you guys have probably seen Dana and Jessica. You guys, I'm so excited that you're here. You guys have been in the community now for, gosh, a handful of months. And This is your guys' first masterclass. So I'm so excited. And is it just me or did David disappear?
David disappeared, but we're going to get David back.
He's coming back.
There we go.
Awesome. Well, yeah, so you guys, they brought on Andy and Dave, and I'll let them actually introduce the guys. But you guys, just so you know, Dana and Jessica are our LO partners in the Moms in Real Estate group. So when you have questions about anything mortgage, like I would literally friend these girls, talk to these girls. They're fantastic. And today they're actually going to be our master classes on the all-in-one mortgage, a game changer you'll love sharing with your clients. And I'll let you guys dive deeper into that. But I'm really excited you're here.
Yeah. Thank you so much. We are so excited. So you've probably seen me commenting all over the group. So we're super excited to be a part of Moms in Real Estate. We're really excited to share this product with you guys. We have the creators of the product here with us. They are so knowledgeable. They know every single detail about this. So we've learned from them. We're excited for you to learn from them. And I think this is going to be a really great tool to help you guys stand out in your field. Just being able to offer creative financing when people feel like they're in a bind. I know a lot of clients can get discouraged really easily. So having the knowledge to have all of these different options out there are going to be great. This is my favorite option. I actually have this loan myself. It is a great tool, and I am going to let Dave and Andy go ahead and share their knowledge on it.
Okay. Thank you so much for having us, you guys. I really appreciate it. It's okay if I share my screen? Is that all right?
Yeah, absolutely.
Yep. And we will bring that right up for you when you share. And real quick, I do just want to reiterate, you guys are nationwide. And so that's something we were talking about. Dana and I were on early. And as a team leader in multiple markets, I'm always like, well, I love my person in like one state, but I wish I had somebody that could take care of all the states. And so we just love that this mortgage crew we have in front of you today can help you in multiple states. So don't worry about it, what state you're in. You don't have to be in Arizona. Okay.
Is this safe to assume you guys see this?
Wrong screen. You're sharing your actual StreamYard screen. You got this. Is always the tricky part.
Yep, because this is a totally new platform.
Stop screen, present, share screen. Okay, share screen, and then allow to share screen.
Yep,
I'm guessing.
That should. Yep. I mean, you show us. You just have to pick which screen. Do you have multiple screens, Dave?
I do.
You just got to make sure you pick the right screen you want to share.
Yeah, so you're not obviously seeing. Okay, can you go ahead and stop that then for me?
Yep,
Sorry,
we did.
You guys.
And when you go to share, yep. And then you can also just go to slides and PDF.
It's on a PowerPoint. It's on a separate window.
Okay.
Within the same. Okay. So slides
so
and
when
PDF?
you pull up, so when you pull up share screen, it should give you between like an entire screen option or a window. Yep. So or your tab. So then you'll just want to take a second and pick the right screen, and then you'll be good to go.
Sorry, you guys.
Don't be sorry. You should see me. I do this all the time. It feels good to not be me right now.
Customer to share your entire screen. Your screen, yes. Allow to share window or allow to share screen. So if I share screen, you're not going to see the PowerPoint.
If you drag and drop it over there, you will.
Drag and drop it.
Yep. Like just make sure whatever screen you're sharing is the screen you have your presentation on.
Yeah, it's all in one computer.
Okay. So then just share it and pull it up. It'll probably just take a second. Just go ahead and share it again like that. And then once you pull your PowerPoint on, it should be good.
Share this window. Got it.
You're just building the excitement, Dave.
I am. Tell me you guys see this.
A bunch of realtors waiting for I saw it for a second. There we go. Yay. We got it. We got it.
Perfect.
There we go. Thanks, Dave.
It's hold on though. It's got to be in slideshow view.
Yeah, it looks great on our side, Dave.
Yeah, but you can see multiple.
Nope.
You can see the slides on the left-hand side.
Nope. We just see the all-in-one loan.
Yeah, just the main slide. That looks good, Dave.
Yep. It's all good. Perfect. There's you and Andy.
Yeah, not allowing me to toggle forward, you guys. Sorry.
Everything's popping right up
here.
here.
Dave, it's going through your introduction.
It's not, because there's a lot of you see this. There's animation within the slides. So this isn't allowing me to toggle forward like that. Let me see if I can. All right, this may work. Okay, that worked. You guys can see this now, right?
Yes, we're in business.
Okay.
Yep.
All right, good. Just like this is the way we like to do things, obviously, is to build the suspense. So thank you. I appreciate it, you guys. Okay, just to get going and kick it off here. Again, my name is Dave Herbst, and I'm the Vice President of AIO Finance for CMG Financial. CMG Financial Services are a parent company. And what that means is I'm the program manager for this product, the all-in-one loan. And I've been with the organization for about 22 years, working on my 23rd, and have spent about 26 years in the industry. My partner in crime here that has joined us is Andy Brown. Andy Brown is my department's business development manager, oversees strategic initiatives nationwide, and he's been in the industry for quite a while. You can't really tell, but he is 75 years old, looking pretty young still. And he's been with CMG for about 9 years. In case you're not familiar with us, CMG is a nationwide lender. We're one of the largest, if not the largest, privately held, family-owned and operated mortgage banking firm in the U.S. today. The CMG stands for Christopher Matthew George. He's our president, our founder. We're about a 33-year-old organization. We're very diversified as well. We operate in every single state, of course. We employ about 4,000 people. We're also a securities firm, a joint venture firm, a builder firm, meaning that we support lending with custom home builds and builders. We're obviously a Fannie Mae, Freddie Mac, Ginnie Mae, direct lender and issuer, and then we're also a mortgage servicer, and we're also a bank now. Bank CMG is a newly acquired bank for the organization, which is very exciting. This product that we're going to introduce to you today is not a new program. It may be the first time you're hearing of it, and I don't doubt that for a lot of you. Part of that is by design, actually. We as a firm believe in education. We believe that people are best served by people who know what they're talking about and dive deeper into the financial endeavor of home buying and home ownership. We certainly make our products and services easy to access, but with that said, we also value the time spent with customers to understand their financial goals, their greater financial goals. And it's in that vein that we began to develop this program out back in 2002. And while it's not a Main Street product today, it's not as popular as a 30-year fixed loan. For a proprietary program, as we developed it out over the last 20 plus years, we have proven to really carve out a different type of category of mortgages. And you'll understand why here in just a few moments. But dating all the way back to 2002, the big idea was to help people just simply pay less for their mortgages. And it does that in a unique way, and actually several unique ways that I'll describe here throughout this presentation. But simply put, if people had more money in their wallet or in their bank account, they'd probably be more active in real estate. And that was the real kind of driving force, the motivating factor with our ongoing development activity with the product. We've had it out for more than 20 years. We've seen the financial crisis. We've gone through COVID. We've partnered with extremely large organizations nationwide to continue to expand it. And present day, we still have no losses nor foreclosures on the product. all the way dating back from 2005 when we launched it. We rebranded the program to the All-in-One Loan in 2012. It used to be called the Homeownership Accelerator, a 9-syllable product name that for a mortgage, I think is unique, a little overkill, but it also inferred that people wanted to just simply pay their homes off, right, or the mortgages off and own their home outright. I think that's definitely an important goal. But I think more importantly, people just want to save money and time, really. And if you can do that, then you can pay off your home loan faster and save a lot of money along the way. We rebranded it to the All-in-One Loan because we had actually licensed it to a very large financial firm in the United States. And frankly, the brand name All-in-One Loan is much easier to spell and remember for people. We were awarded a U.S. patent in 2010 on this program, so it's got lengthy, established, high-performing history for a mortgage program. It's not easy for a lender to create a proprietary product out of thin air. The entire industry is sort of cemented in, conventional financing. So, the idea behind this loan is unique. The way it achieves benefit for customers is one of a kind, and this is an exclusive product available through CMG Financial, CMG Home Loans. So let's start with why. I think this is the most important part of everything. Why innovate a mortgage? Why do that? Ultimately, it really comes down to where customers, what mortgage products have really done for customers and home buyers along the way. We think pretty deeply about this stuff. We write white papers, articles very routinely, and publish those internally, and I'll make some of those available at the tail end of this if you're interested. But we dive deeply into the data to understand sort of the trajectory and how the mortgage may be impacting household financial well-being and their ability to actually maneuver through life as life gets pretty expensive, as we all know. A lot of people probably don't know that traditional loans, just your regular conventional mortgages, were designed during the Great Depression era for very specific reasons. They were designed to help convert the market from renters to homeowners, and of course to aid with the veterans coming home from the war, World War II, and make homeownership much more attainable. Prior to the development of the 30-year fixed mortgage and other common mortgages in 1938, financing real estate was very, very difficult. It generally required about a 50% down payment. Also, generally came with a balloon payment, payable, completely due in 3 to 5 years. Homeownership was not attainable for most Americans, and FHA, as part of the New Deal, brought forth forward amortized lending as we know it today, common mortgages that we still use today in 1938, and it's definitely served a purpose and arguably created a middle class, right? Helped create a boon in America, if you will. But we start asking questions. Is this still suitable today? Life back then was very different than it is today. And it's sort of an oddity, if you think about it, that we're still using the same products. Everything in your life has innovated, it seems. Everything. You can check on your house, right? From the other side of the planet through your mobile phone. You can turn on the oven from 6 miles away through your mobile phone. Cars have innovated. The telegraph to the telephone and mobile device, everything around us that we use on a daily basis is innovated. Somebody set forth and said, let's start making some adaptations to an everyday normal product. And those adaptations result in an enormous change, a significant change that ends up changing the way people think and behave. And that's exactly what this product represents, the All-in-One Loan. Our company philosophy is really at the core of the product. And I don't know if every lender thinks this way. I do think that we're highly unique, and that we know how powerful the mortgage is. We know how important it is. But we also know that it's not just a tool for home ownership. We see it also as a critical participant to financial outcomes. It plays a role in developing financial security. It plays a role in developing market health. And the mortgage put in place proves to either accelerate those goals or impede them, quite frankly. So we see the mortgage as not just the financing portion. That's the easy part. What we really see in a mortgage is that it's going to have an impact, for better or for worse, on somebody's financial trajectory. And we prefer the former here. We'd rather accelerate personal wealth development. We'd rather make it easier for people to buy and afford home ownership, as rewarding as it is, versus just continuing to transact and put people in debt that tends to linger around for much of their adult working life. That's not our goal. When you take a look at borrower behavior and demographics today, wildly different than what it looked like, nearly 90 years ago, back in 1938, when common mortgages were put to market. And again, we're asking the question: are mortgages getting easier or harder to afford for people? Certainly things have changed. Today, the average age, mortgage holder that owes the most amount of debt is about 53 years old. The average age mortgage borrower being 55 years old. We also know that the average duration left on a home loan today is about 25 years. So think about that. Average age person that's active in real estate and owes a mortgage is middle-aged, 53 to 55 years old, and they've got about 25 years left on their home loan. That's your current housing market. And I think those data points are vital, because as a real estate agent, you have to understand, and I know you do, that your best next customer is the one you have in your database, the clients you've already served, because arguably they're dreaming and they have been dreaming about their next purchase, whether that to be moving up or moving down, maybe do a better job, or just simply do a better neighborhood across town. Either way, large percentage of the market, housing market today, people that have a mortgage already might be dreaming about their next purchase, their next move. But ultimately, these folks don't execute each and every single year. We don't see that high percentage of people executing on home purchases. Why? Because generally they're locked into interest rates. And the problem is they've got a lengthy period of time left on their mortgages. Today's mortgage debt equals nearly $14 trillion large. That's outstanding mortgage debt for the entire, for all homeowners that owe a home loan today. We also measure, what that might impact. Of course, retirement in security is one of those things. Are people having the ability to save money for their own retirement? No, by and large, they're not. Americans are falling way short of saving money. And why do we value that data point? Because, this is during our peak earning years is when we're a homeowner. And this is when we tend to have the ability to save for things like our own retirement security. But by all accounts, the working age, pre-retirement age households are about $7 to $14 trillion behind their own retirement goals. Gen Xers and millennials combined owe the most amount of mortgage debt. That's awful. Gen Xers actually owe more than the millennial generation. Millennials, though, are catching up very rapidly. As a data point, it's interesting to watch. Their trajectory of indebtedness is accelerating, and they've had fewer years to actually build, established financial behavior. 60% of all baby boomers still owe a mortgage, and 24% of seniors still owe a mortgage. This is awful. We look at these data points and say, the mortgage is partly responsible for the well-being of the people we serve, not just to transact and get them into a home at the time of purchase, but then what? I think the industry is very good about helping people get into that debt, but not very good about helping people get out of that debt easily. And that's our focus. That's why we dive so deeply into these data points. Median age for all buyers today is now 59 years old. Median age first-time home buyer is now 40 years old, and an all-time high. Clearly, we're headed the wrong direction, it seems. When we break down household debt as a share of all the money spent on debt to service our car loans, our credit cards, et cetera, student loans, it doesn't get any greater than the mortgage. Statistically, it's the biggest financial expense that we'll commit to in our lifetime. And as everybody knows, that comes with a boatload of interest cost. And this is a problem. And we tend to rely on interest rates, of course, to reduce our cost, to reduce our payments, but that tends to not work very well. I'll kind of show you. We've had access to low interest rates over time, arguably, and relatively speaking. Yes, it's nice to have a 3% rate. That's better than 6%, given standard mortgage product structure. But, even with low interest rates like we've had over an extended period of time, we see that income isn't increasing along with home prices, and low interest rates don't solve that issue. So home prices continue to tick up, and I don't think there's anybody on this in this meeting or watching this right now that wants home prices to dive down. I don't think so. I think that when you are a homeowner and you commit to that, it's an investment into your future and potentially your family's future. Nobody wants their home's value to come down, but we all want to pay less for our mortgages. Nobody wants to pay a penny more than they have to. So how do we solve that issue? Not wish for or wait for rates and spend our time trying to time the market, but actually spend time in the market where we can have greater affordability. Traditional mortgages, I'm not saying are not still suitable for a large percentage of the population. They certainly are. They were designed for those that were newly establishing their budget, ultimately first-time homebuyers especially. They're readily available. They're sort of a commodity. They don't take much education, right, to use. So that's all the good. But there's some cons that come with traditional loans. And we just simply take the position that, one size fits all solution has sort of led us to a lot of strain and helped create that the affordability gap. We think traditional loans are slow. Clearly, they're slow in their repayment structure. About 90% of homeowners choose a 30-year loan. We've heard talk of a 40-year loan or a 50-year loan one day. The longer you take to repay a debt, the more it costs you, and that's added unnecessary interest expense that loads up life. And we think that's not the right direction. We set out to introduce a better way to do it, a faster way to do it. Without question, traditional loans are inefficient in how they apply money. We know how it works. They're rigid in their structure. You can only make a payment towards a mortgage. You can't take that payment money right back out. So they're rigid. And all of this sort of disincentivizes buyers and borrowers from paying more than just the minimum required, right? So we kind of hang on to mortgage debt longer than is actually necessary. And this leads to increased and unnecessary cost over time. The sort of at the root of the problem is an amortization schedule. All loans come with one. All forward mortgages come with one. Common loans, an amortization schedule. This is the most expensive component of a mortgage. This is how payments are calculated, how interest is calculated. It's all predetermined before we even close a loan. And this is the construct of what was developed and put to market back in 1938, and it hasn't changed since. And I know you guys know how it works, but money flows directly to principal primarily first. Very little. To interest primarily first. Very little goes to principal. In fact, it can take upwards of 21 years before the amount of money that's been contributed towards a mortgage begins to teeter now more towards principal than interest cost. And we set out to change this. In fact, our loan, the all-in-one loan that I'm exposing you to today, removes this entirely. There is no amortization schedule, none whatsoever. We want our customers to define how much interest they're going to pay, how fast they're going to pay it down, what their balance is each month, instead of us, instead of their lender. It's a bright idea, it's a very positive idea, and that change is overdue. When you think about it, mortgages are just a mathematical equation. To change this, the way a mortgage works is not that difficult. It's really not. It's just a mathematical equation. And this is the same equation, financial equation that exists with all financial products, whether you're borrowing money or you're investing money. It's really all the same. If you're investing money, the same three variables at play. When you're borrowing money, you're worried about your rate. You're worried about your principal balance and of course the term or the time of the loan. Like I said, most people will choose the lengthiest time on their mortgage, which delays pay down of principal. And we get sort of hyper-focused on interest rates, but none of us controls interest rates. These are market forces that none of us control. But this is the way people sort of behave because of the design of a traditional mortgage. Here on screen, just to present sort of an argument that the interest dollars we have to pay versus the interest rate that comes with our loan is more important. I've got a 6% loan here. Regardless of the amount we borrow, repaid over 30 years, that loan would cost us 116% interest cost relative to the amount of principal being borrowed. It doesn't matter if we're borrowing $100,000 or $1 million or $10 million. 6% on any balance repaid over 30 years is going to cost us more interest than we are borrowing in principal. So borrow $100,000, repay $216,000, right? Because an extra $116,000 is interest cost. That's not that great of a deal, but 6% is a fairly favorable rate. It's better than 6.5, better than 7, right? And when 6% shows up on a 30-year loan, people start to mobilize a little bit. So it's great. But my point here is that it's still not an inexpensive endeavor. We can do better. And, even looking at COVID era interest rates, the 3% mortgage we paid over 30 years, way better than 6%, but it's still expensive. $52,000 in interest for every $100,000 borrowed. So what we did is we took a look at the mathematical equation dating all the way back to 2002. And we said, how can we actually apply money differently to the mathematical equation so it impacts our cost more directly? Well, we do that by prioritizing principal reduction. And time reduction. And it doesn't get any better than a principal paid first mortgage, which is exactly what the all-in-one loan is. By reducing principal faster, it reduces the amount of time somebody carries a mortgage and offsets the amount of interest that that customer has to pay. In fact, you could have a higher rate mortgage with fewer payments and save a significant amount of money. This reduces the cost compared to that 3% 30-year loan by about 15% or so. That could be tens of thousands of dollars in interest costs. So consider the fact that interest rates mathematically are not the most important value when it comes, or variable when it comes to financing real estate or financial tools. The all-in-one loan is built on this concept. How can we lower the cost without lower interest rates? Well, the all-in-one loan does that. It achieves that. And again, I gave you a hint because it's principal paid first. And I want to briefly kind of outline what the all-in-one loan does, what it helps people achieve. Number one, it lowers interest costs without requiring lower interest rates for the right candidate. That's what it does. In fact, it can save somebody so much interest that it can be like getting a rate today below 3%. That's very typical. Even sometimes we see the benefits so significant that it's like getting a rate below 2% for our customers. Imagine that, especially as a real estate professional. That's something to talk about, because again, we know that interest rates tend to motivate people, right? The lower they go, the more motivated they are to do something, especially hopefully continue to purchase and participate in the housing market. But, again, none of us controls interest rates, and we might be waiting a very long time for interest rates to come down below 3% or 2%. It may not happen in our lifetime. This loan is designed to reduce principal so fast that it also reduces the cost somebody has to pay. So it's similar to achieving a mortgage, even in today's environment, with a rate well below 3% typically. Number two, it accelerates payoff, obviously because the principal paid first. Accelerates payoff without a change in household budget. So without disrupting somebody's lifestyle, it pays down faster, typically 2 to 4 times faster. And that obviously puts our customers in a much more improved equity position earlier in the process. Who wouldn't want more equity? One of the best questions we can ask somebody is, how much equity do you want in your home in the next 12 months? What if you had control of that? What if you could build it faster without any change in your budget? Would you want to know about that option? That's exactly what the all-in-one loan produces. And number three, it's a safe way to reduce the principal balance and reduce costs, because it also supplies access, 24/7 access to home equity dollars without refinancing once this is in place. So it's what we call an open-end mortgage versus a closed-end mortgage. Traditional loans are closed-end. You can only make a payment into it. Can't take that money out. An open-end mortgage allows somebody to put money in and take money out. Now, open-end mortgages aren't mainstream, but we took the concept of an open-end mortgage and completely restructured it, redesigned it. Having access to money is important because it not only provides people greater financial security, but it also allows, makes it much easier for the homeowner to fund other financial challenges and opportunities that come about. We know that life isn't fixed. And we believe that customers, homeowners, should have access to their home's wealth as they grow and accelerate it. That way they don't have to go chase interest rates and chase mortgages. The all-in-one loan is designed to be the last loan, first and last loan, frankly, that somebody would ever need on a property. And it can help somebody buy additional properties. And that's a key factor and a key thing to promote. This just accelerates financial goals. So here's how it works, you guys. I'm going to keep this sort of high level. We call it the all-in-one loan because, of course, what we've done is we've merged two normal everyday components or services and products together. We've merged a mortgage with personal banking, home financing and personal banking wrapped up into one financial tool. When I say personal banking, I mean a checking account. So the all-in-one loan is a mortgage that comes with a checking account integrated within it. And checking account, I mean a fully consolidated banking and borrowing platform all in one place. ATM debit Visa cards, online banking, mobile banking, check writing, ACH transferring. You can link external accounts. You can add non-borrowing authorized users to it, and wire money nationally, internationally, and domestically, of course. This is not fintech. This is a actual true bank account integrated inside the mortgage. Well, let's talk about bank accounts, checking accounts specifically for just a moment, why this makes sense. We refer to checking accounts as the birthplace of net worth. And what I mean by that is this is where everybody's money lands. Everybody we know, every customer that qualifies for a mortgage knows how to use a checking account. And they typically use one to manage their income through. Of course, that's where money lands. And then from there, it's dispersed. But what we also know is that a lot of people don't think that deeply about their checking accounts and the volume of money that actually flows through it routinely. The truth is more money will pass through a standard consumer checking account in the course of 5 years than the amount that they're going to owe on their mortgage. Just consider that of every single one of your buyers out there as you listen to this. Every single one of your buyers, I want you to look at them differently. Think about the amount of cash flow. They use a checking account. They're going to qualify for a mortgage likely. And understand that the volume of their earnings that transfers or that they manage through their checking account is probably more in just 5 years than the amount that they're going to owe on the mortgage they need for that home purchase. And when you think about that, it's sort of empowering. Why does it though? We pose the question, why does it take us 30, 40, 50, 60 years or never at all to actually repay a home loan these days when we have the resources available? Now, we also know that the other powerful component of a checking account is that the money as it's received doesn't get all spent back out the very next day. It floats. We get paid however we get paid, from commissions to paying ourselves from our businesses to just regular wages or commissions. And then we sort of allow that money to sit around before we need it. It kind of loiters in our checking accounts. And as we spend our money out periodically on our bills and expenses, that's a very powerful resource that's sort of sitting there waiting to be spent. Unfortunately, we know that as money's waiting to be spent on our bills and expenses periodically, that money is really not earning us anything. Checking accounts don't pay us very little interest at all. And the interest we do yield on checking accounts, we have to pay income tax on. So, it's clear we always pay out more interest on our debts than we get paid on our earnings. And this is where the adverse relationship exists that we break down with the all-in-one loan. The all-in-one loan checking account is different. It's structured differently. It doesn't allow money to actually reside in the checking account past a single day. It's got a mechanism built into it called sweep or sweep banking. So the all-in-one loan checking account is a zero balance sweep checking account. So it's actually engineered, unlike traditional checking accounts, to receive money securely, just like a normal checking account, but move it or push it directly to the mortgage balance the day it's received. So an all-in-one loan customer, the day they get paid or they receive money into their all-in-one loan checking account, they will literally see their mortgage balance reduced by the same amount that day. All of that money is used to curtail principal, 100% of it. It's gratifying for somebody. Imagine if you owe $400,000 in your mortgage balance, your all-in-one loan mortgage balance, and you get paid $10,000 or whatever it may be, your mortgage balance drops by $10,000. It drops to $390,000 that day because that income deposit was received. It's gratifying for customers because then it begins to engage and allows them to engage the debt and think, I think, more sensibly about their spending. This certainly helps people, be much more aware of their cost and the power of their money. The truth is, while they're not using their money, though, it's keeping their average daily balance lower. And that's a benefit because on the all-in-one loan, I mentioned earlier, there is no amortized interest. The interest cost somebody has to pay on this, all the interest payments baked into a traditional loan do not come with this loan. It actually is the only loan in America that recalculates interest cost and payments daily and monthly. So we just take the interest rate, divide it by 365 days, and we multiply that by the nightly loan balance in which the customer controls. And that's the daily interest cost. So every single day gets its own unique interest calculation. And at the end of every single month, each day's interest is totaled up, and that becomes the interest payment. Anything already in the loan that wasn't spent is already there against principal. We've simply closed the gap between banking and borrowing. We've streamlined the process. Get paid, make a deposit, your balance drops. Interest then recalculates on a lower balance. That means that our customers or manufacturing or influencing a much lower interest payment each month. And the interest payments on the all-in-one loan are not predetermined. They're summed up at the end of the month, and that interest payment becomes payable on the 21st of each new month. So in real terms, here we are in February 2026. So each day's interest from February is going to total a monthly interest payment, and that interest payment is actually going to be payable or due on the 21st of March. And actually, for most cases, that's actually drafted automatically from the all-in-one loan mortgage automatically for the customer. So very convenient. This just reoccurs every single month. Customers control their principal, lower their daily interest and monthly interest payments month over month. So every single month they see a lower monthly payment automatically just by using the account. It's sort of a rewards-based mortgage. The more you use it, the better it gets, the easier it gets to repay. Whatever's not spent after spending, it just resides in the mortgage and in the home as equity dollars. And those equity dollars are completely available 24/7. So if there's an unexpected emergency or maybe a financial opportunity, those dollars are liquid. Somebody can just write a check or spend those dollars if they wish. Or if they continue to leave them there, those dollars will serve to compound the benefit every single month and accelerate the pay down automatically. So discretionary money not spent. And of course, there's no longer a traditional mortgage payment in the sense of a P&I payment like a conventional mortgage. No longer have to spend those kind of dollars from your pool of money because they're already against the mortgage. So together, those just compound the reduction of the principal and interest savings. In the meantime, money resides inside the loan, completely available 24/7, liquid. We've made the mortgage the storage place of idle dollars instead of a low interest bearing checking account. But it comes with the same functionality as a checking account because they're merged together. Now, this all works because on the mortgage side of the all-in-one loan, it is an actual line of credit. It's a first lien position line of credit, 30-year line of credit, 30-year draw line of credit. This is the only one in America that's structured this way, you guys. It's a very unique product, very unique. So we all know how HELOCs work, and they're typically in second lien position. This one's in first. Traditional HELOCs tend to cut off access after 10 years. This allows access for a full 30 years. So it creates a lot of opportunity for people to continue to use it sort of as a flexible credit facility on their home to help maneuver through life. Just makes things easier. And all the meanwhile, their cash flow develops savings through rapid principal reduction. There's no balloon payment. There's no prepayment penalty, of course. That'd be weird. And that liquidity aspect of the loan is vital. This is what's valued, I think, most amongst our customers. The credit limit is sunsetted or stepped down beginning after year 10. So we just decrease the line of credit limit automatically and evenly after the first 10 years. And we do that monthly by 1/240. So it's a reduction. And that's drafted up on the loan document. So every customer knows exactly how much their line of credit will be automatically reduced by beginning year 10. But it's structured this way so we can enforce a pay down and a payoff by the 30th year. But again, this is real kind of case study illustration on screen here. People use this loan for a variety of different reasons, not just to make that one purchase possible, but to also maybe supplement college tuition cost for children, maybe buying more properties. This definitely proves to help people accelerate those goals, but also contend with other financial challenges, medical expenses, the unexpected stuff that occurs over life without having to go get more loans. And the truth is, nobody wants more mortgages. There's not a single one of you or any of your clients that want more mortgage terms in their life. Nobody wakes up and goes, God, you know what I got the hankering for is another 30 years of mortgage debt. Nobody does that, right? We know what people really want, which is fewer years, lower cost, lower mortgage burden in their life. So this allows them to do that using money they already have through a mechanism they're already, comfortable using and know how to use, to pay down a debt at an accelerated pace that they've already committed to, their home loan debt. And the result is that they're able to pay off typically 2 to 4 times faster. And to test that suitability, we use our proprietary interactive simulator. It's a calculator that actually allows us to input, and it's publicly available through allhomeloan.com, of course, if you wanted to go there, and also through our lending team. You have their contact information. You can get to the calculator, and it assesses cash flow behavior and of course potential savings benefit, and it's staggering. Andy, I was going to pull up the website, but I have a feeling I'm going to probably have trouble sharing the website.
Yep.
So I'm just going to pass that. Go ahead.
Yeah. So let me just explain the simulator real quick. So I have the unique opportunity to speak with all of our loan officers across the United States and their clients. And what we find is that what they want to find out is, this is the part where, how do we know whether this loan is actually financially suitable for somebody? What's the benefit of utilizing a loan like this versus a traditional loan? The simulator allows us not only to view up front whether this loan is more appropriate than a traditional loan, or the loan that somebody has currently on their home, that low rate loan that they think that can never be better, at 3.25% today. Well, this is the opportunity to look at how applying money towards principal faster, utilizing the available resources that somebody has in their lives already more efficiently, to reduce that balance faster and achieve a lower interest cost, even versus a low rate, quote, low rate loan today. The simulator is our way to do that. We forecast this benefit for people. This is one of the reasons why we've had no foreclosures in 20 years, because not only are we putting the right people into it, we won't put someone in this loan if it's not better for them than a traditional loan. It's part of our underwriting process. But secondly, the loan actually works. As Dave mentioned, it puts somebody in a better equity position earlier on in the mortgage process, when typically we know that our payments are being consumed by interest costs. Over the first 5 years of a traditional mortgage at 6% today, 82% of your payments that you'll be making will actually be eaten up by interest costs just in the first 5 years. It's a lot of money that gets wasted. So we say, why don't we just flip that, apply all of somebody's money towards their balance before interest is even calculated. This has tremendous benefits. The simulator is how we forecast that benefit for people.
That's right. And the simulator goes deep. It goes as deep as somebody wants to dive in. It also includes our rate options right on screen, so somebody can really kind of test drive what might be best for them, or whether or not it's going to be suitable compared to a traditional product. It also shows a pay down graph, forecasted payments, and it's shareable. It produces, every single simulation is unique, and it produces a unique key code, a 9-character alphanumeric key code that can actually be shared with a financial advisor, or you, real estate agent, our loan officers, so that we are all on the same page and understand, how this is going to perform and what the customer is interested in reviewing. So very easy to use tool. And again, I encourage everybody to go to the website or work with Jessica and Dana's teams to dive in and see how that works, and whether or not it might be right even for you. Let me cover lending allowances very briefly. Can't do this webinar and talk about this loan without providing some understanding of what this product will lend to. I'm going to close out of a couple things. Here we go. Okay, so this is a manually underwritten loan. It's a proprietary product. We do follow agency standards, Fannie, Freddie standards, and industry norms, of course, with this product, but it's privately secured as a mortgage security goes. But with that said, we follow all norms and practices throughout the industry to comply with all regulatory, rules, of course. Being manually underwritten, though, allows us some flexibility. So we can think outside the box and continue to expand our guidelines, you know, as the market needs and as individual customers need here and there. And it does require reserves, typically 10% of the loan amount. So unlike a traditional mortgage, you can tell this one is really intended for savers, good savers, and where there's good budgetary behavior. So we want to see that demonstrated by documenting reserves in the file. So 10%, we use full face value of retirement accounts, even value of life insurance policy, cash value. Our debt to income requirements are a little tighter, about 43%. But again, this is really for the borrower that seems to be well established in their financial behavior. So that should not be a problem. Some nuance allowances. This has a very aggressive asset depletion feature, which means this is great for the self-employed, especially, or just great savers that have a low amount of income, maybe even passive income earners, and even retirees. Where we can actually use assets without pledging those dollars or without liquidating those dollars as income, and which is great. It creates a lot of opportunity. We also have a 12-month bank statement qualifying feature within the loan for self-employed. And now somebody could be self-employed and W-2'd. Could have dual income or multiple borrowers by using this. But the use of bank statements just helps us, look at cash flow, analyze cash flow from businesses to help somebody qualify, where otherwise that would be very difficult. And of course, we have a delayed financing feature on this. So if you have cash buyers out there that are still purchasing property and liquidating some assets, we require no seasoning requirement. So the day after that purchase transaction is closed, we can take an application out and help that customer get their good portion of that money back, typically up to 80% of the purchase price, without having to wait 6 or 12 months to get access to their money. So that's great. The terms of the loan, as you might have guessed, this is not a fixed rate mortgage. We don't want to fix the cost. We don't want to predetermine and fix the cost into the mortgage. We want the customer to control those things. With that said, we structured the rate to be favorable for both lender and borrower. Everybody's afraid of adjustable rates. There's no reason to be afraid of adjustable rate loans when they're structured like the all-in-one loan is. Our rate is tied to the 30-day average SOFR. That's an index that's widely used globally now, and that stands for Secured Overnight Financial Rate. And its historic average since adoption is about 2.3%. So very low index. And it tracks with the Fed funds rate up and down. So it moves very methodically, very slowly, very predictably up and down within a sort of a range of interest rates. And then, of course, we have margin options, 7 actually, where every customer gets the same options to choose. These margins, that's the fixed portion of the interest rate on top of the index. And that then equals or totals the fully indexed interest rate somebody will pay. And when it comes to interest rates, and we'll get to this in a common question section here, but when it comes to interest rates, understand that your biggest hedge against cost and having to pay interest dollars is not necessarily the interest rate, as I've demonstrated earlier. The biggest hedge and protection or insurance policy that every one of us has is our own income. Now, we just have lacked the ability to use that income more effectively. That's what the all-in-one loan does, is it harnesses the power of just regular everyday dollars to lower interest dollars paid or charged, and that creates a substantial opportunity for people to retain more of their income. And there's no impound account on this, the last bullet point. We don't collect for taxes and insurance. The customer is responsible, because the whole idea behind the loan is to allow people to use their money more so than us, right, to benefit. Moving forward. Here's our primary residence. Residences matrix. We lend up to $6 million. And decent credit score, 700 is a minimum. Notice that we also supplied lending or financing for multiple units, single-family residences, condominiums. Our second home matrix looks very similar, but we don't go up to 90%. We go to 90% on the primary residences. I don't know if you guys saw that. 80% maximum loan to value for second homes, up to $2 million, but we lend as high as $6 million. Investment properties, we lend at $2 million. You need a 720 minimum, up to $1 million for investment property. If any of you own real estate and rent those out, short-term rentals, long-term rentals, or if you're working with clients that do, past, present, or future. This is a phenomenal opportunity. It's a no-brainer. There's really only traditionally, two ways to sort of reduce cost and grow your positive cash flow in real estate owned, and that is to refinance typically, or to increase rents. That's not always feasible, right? You don't want to scare away a tenant or price yourself out of the market. And again, interest rates don't always cooperate. So what better way to do it than get a principal paid first mortgage where the leases or the rents drive directly into the loan, paying down principal, which accelerates pay down and equity development, keeps all that money liquid, and also reduces every single month's interest payment ongoingly, drives it to zero sooner in the process, which is what everybody wants anyway. It just allows property investors to execute on their goals: purchase, fix up, sell, go execute, go build your portfolio. We also, sorry, that's not supposed to say investment property, it's supposed to say construction loan. This is, we're very excited that we released about almost a year and a half ago, a one-time close construction product. It's not available for investment property, so don't pay attention to that. It's available for primary residences and second homes only, but it's a one-time close for custom home builds. Somebody owns a home, they want to scrape the property and build a new home using the all-in-one loan. Perfect. We finance that. The draws for construction come off the loan, and there's no second closing, no modification. It's very convenient. And while the construction is going on, the customer gets the opportunity to just use their cash flow to pay down their balance and grow equity before their home is even completed. Phenomenal opportunity. Still a 30-year draw line of credit. Now, common questions. This is really the second to the last slide that we'll kind of breeze through. Andy, if you can unmute yourself, I'm gonna have you answer these if we can.
Yeah.
Number one.
I do know that I think we want to have some open time for questions here too. Are there questions we want to get to before? I know we're coming up on the 8 minutes left here.
Yeah, we have a handful, Andy. I think some of them have been answered, but one of the questions was, what type of client is the best fit and who's not a good fit?
Sure. Yeah, I mean, obviously this obviously opens up an opportunity here to think about who's right for this product. Well, the way we position the product is anyone that wants to pay the least amount for their mortgage obviously would benefit from this loan, right? Now we need to determine whether it's right for that person. The people that do the best with this loan are going to have high cash flow, okay? Positive cash flow, I guess, is more the term I should use. Positive cash flow, someone that's not paycheck to paycheck, that's going to be saving for retirement, doing the things that we do to prepare for ourselves for retirement. We're already doing those things, right? But obviously someone that has more cash flow, that has a lot of positive cash flow, that are looking for alternative places to store funds, those people can benefit really well from this. By having more available resources, they have the more ability to use those resources more appropriately to efficiently pay down the balance of the loan.
I actually have an example for that, since I have this product myself. So our primary residence has the all-in-one loan product, and then we used the funds from the all-in-one account to purchase our second home. So it can be used for things like that, which I think is really great. And just kind of expanding your real estate portfolio without having to, do more and save more. It's all in one place, which I think is great.
Yeah, a real benefit, honestly, that a takeaway from this is to think about what Dave mentioned early on in the presentation when he talked about your current database. Most of our clients are waiting for rates to come down, and that may or may not happen, right? 90% of the market has rates below 5% today. And we should think about that. There's an opportunity cost there for them. We want to be able to call these clients and talk to them about a product that maybe can get them to move forward off of the fence, so to speak, and purchase a new home, because they don't have to give up the low rate loan that they have on their home currently. We can show them a path of affordability to cost them less than even the low rate that they have on their loan today. This opens up a wide demographic that most of us aren't even calling on today. Okay.
Awesome.
Any other
Okay.
questions?
So, yeah, we have a few. So real quick, Celeste, we did put that back up there, but also Dana and Jessica are available. They're in the community. You can always go to our website, heymeyer.com, and all of their contact information is there. So make sure you connect with those ladies.
Yeah, we'll send out some information too, just about the product itself. And then, yeah, if anybody has questions, we're more than happy to hop on a call anytime and kind of go through it, the nitty gritty and anything maybe that's specific to a borrower. So
yeah.
I did see a question about refinances. Yes, we can absolutely do a refinance into an all-in-one loan.
Okay, perfect. Yeah, there's a handful. Let's see. I think we already did that. Yeah. Oh, so can you still list the people that, okay. So I think Dana and Jessica will handle that. I know there's lots of questions coming in here. It is recorded, but I would also say that it might just be best to jump on a call with Dana and Jessica, because then tell them what you're thinking and they'll be able to shortcut that for you. And then one other question was around associated fees. So can you talk about the associated fees with the loan? Does that just kind of depend on the individual borrower, or?
The fees associated with this loan are going to be traditional transactional fees that come with a mortgage. Now, obviously, there are 7 different rates to choose from, margins to choose from with this loan. So depending on whether you want to buy down the rate like you can with a traditional mortgage, we have those opportunities as well to buy down the rate as well. So, but traditional fees exist with this loan. It's no different than from any other loan that we would do.
Perfect. And Dana, I think this was the one, it was Hannah that was asking if somebody using another lender could refi through you guys. And you did say yes, right, Dana?
Yes, absolutely.
Okay, perfect.
You can do it as a purchase or a refinance.
Nice. Okay. Well, I think today what we did is, we're all in this industry and we've all got to understand the big picture. And so today we really did a deep dive in all of the moving parts Dave walked us through. And so thank you so much for doing that. And so now for those of us that just function like, us traditional agents, and we're excited and we're like, all right, let's get some conversations going. Dana and Jessica, what is your preferred method for them to reach out to you ladies?
We could do a call or an email. If you guys wanted to reach out to me, I'm more than happy to just get the conversation started. We can talk about scripting, anything like that that'll help you have a conversation with your clients. We'll give you guys a rundown of just the basics. And then if you want to pass them off to us, we'd be more than happy to do a deep dive with the borrowers as well and just kind of walk them through everything. We can show you the simulator if you're interested. I'm more than happy to show you the simulator to compare the traditional loan to the all-in-one loan. I find that that's a really powerful tool with sharing this information with borrowers. So I'm more than happy to go over that with anybody that has a scenario where they think this might be a good fit. I can definitely.
I have a suggestion. Why don't we do that on the morning show with both of them, where we actually can bring everything up side by side? I think that would be really fun.
Absolutely, we can do that.
I think that would be great. And also, some marketing messaging around how agents can actually bring this, to their clients and start conversations. Those would be 2 great things to get on the morning show.
Absolutely.
All right. Well, more to come. And as always, thank you, ladies, for joining us. And for all of our moms in real estate, don't forget that we do have them as lending resources for all things, not just the all-in-one mortgage. So thank you, gentlemen, for joining us today. It's not often we have men and moms in real estate, but we were thankful that you were here. And we hope everybody has a wonderful day.
Thank you guys.
Bye, guys.
Thank you.
Bye, guys.
Bye.